Hello guys, and welcome to this video on example 14.12. So if you look at your blue textbooks, your test your knowledge of accounting, you're going to turn to page 207. I'm just turning there now to make sure that it's the right page. Yes, 207. And on 207, you're going to find this question. I've reproduced it here for our convenience. And we're only going to be doing part A, so the calculation of basic earnings per share and diluted earnings per share. Remember the disclosure part, there's a separate video up on your Blackboard page which you can look at. Disclosure is simply just a reallocation of the numbers that we calculate in this video. I would encourage you to do the disclosure on your own to make sure that you know exactly which number lands up where in the note as well as on the income statement. Okay, so let's read the question. So it says, on the 31st of December 2019, I'm reading under information, right? So we know that we need to calculate the basic earnings per share and the diluted earnings per share for the year ended 2019 or 20x9. So I'm going to be reading from the information part. So it says, on 31st December 20x9, the issued share capital and debentures of Wetlock Limited were as follows. And so it tells us that they're ordinary shares of R1, right, each, okay? So these are rand amounts, right? So the amounts that you are seeing here are actually rand amounts, but we can also take them as share numbers or the number of shares because both of them are R1 each. Okay, so the ordinary shares R1 each. We've got 2.5 million in both years. So there seems to have been no movement in the years under review. We've also got 10% convertible debentures. Remember, convertible. As soon as we see the word convertible, we start thinking dilutive, right? So we're looking at dilutive earnings per share. So 10% convertible debentures at R1 each, again 2 million each, right? So there's 2 million in both years, no movements. That's reiterated by the next statement that says there were no ordinary shares issued during the years ended 31 December 20x9 or 20x8. Okay, it then goes on to say the profit for the year was 800,000 and 750,000 for the years ended 31 December 20x8 and 20x9 and 20x8 respectively. Now, what I wanted to say was this is profit for the year, right? So are these amounts pre or post tax? Are these amounts pre or post tax? Well, we know that if they were post tax or before tax, they would be called profit before tax. If they're after tax, they generally are termed profit for the year. So this is after tax. So we don't need to take into account the tax effect on these specific amounts. That might not always be the case, right? So let's keep that in mind. So on these specific amounts, we don't need to take the tax into account. It says the convertible debentures were issued on 1 April 20x8. 20x8 is which year? It's our prior year, right? It was issued within the year because according to what we're seeing here and based on the question, we know that the year end is 31 December. So it happened basically 3 months into the year. January, February, March, and then in April, 1st of April, it was issued, right? So how many months has it been in issue for in 2018? How many months have these convertible or dilutive debentures been in issue for in 2018 or 20x8? It's been in issue for 9 months of the year, okay? 9 months of the year. So the convertible debentures can be converted into ordinary shares in 20x10, okay, at 4 Rand per share. Okay, they can be converted into ordinary shares in 20x10 at 4 Rand per share. Okay, it then says that we must assume the debenture interest for the 20x9 year is 200,000, 20x8 year is 150. We assume that it would be smaller. We assumed that it would be smaller in 20x8 because it was only in effect for part of the year. Okay, and there's the tax rate. Remember, we're not taking the tax rate into account when calculating profit because that's already been done. They are giving us the tax rate so that we can calculate the after-tax effect of the convertible debenture interest. Okay, so let's start off with our calculations. Okay, so we're going to start off with our profit, right? And remember, we had 800,000 in 20x9. We had 750 in 20x8. Okay, so when we're looking at that, we then want to, firstly, do we have any preference dividends? Cumulative, non-cumulative preference dividends, right? No, not in this question, but we must always put that in our calculation because in our other questions it might come up. So we've got an amount, we started off with 800,000 and 750 in the prior year. There were no dividends, preference dividends that we need to take into account. So in fact, our profit is exactly the same as our basic earnings. Okay. Then we want to look at the after-tax effect of debentures. So we were told that we had 200,000 in 20x9 and 150 in 20x8, right? So we're going to take those amounts and we want to reduce them for the tax effect. Now, in your question, they show you what the calculation would have looked like if they hadn't given you these amounts. Well, we're not going to look at that because we did receive it in the question. So in the solution, it has like a calculation to explain why those amounts were used. And then we multiply it by 72. Why 72? Because the tax rate is 28. So if we take out the tax of 28%, we're left with 72%. And the 200,000 then becomes 144. And the 150 then becomes 108,000. Okay, so we want to add these amounts back. Remember, we're adding them. Why are we adding them? Because we're assuming that these debentures, convertible debentures, have now been converted and are now ordinary shares. Therefore, we don't need to pay this dividends. And it's the after-tax effect because we no more can claim that tax. Okay, we no more can claim that tax. That relates to that interest. Okay, so now let's have a look at the WANOS. Again, very easy basic calculation. It starts off with an opening balance, which we got on from our question. It ends with the same, the basic WANOS ends with the same amounts. And then in the current year, we would not weight those shares. So there were 2,000 Rand worth of shares, and they were all at 4 Rand a share. So if we divide, 2 million, there were 2 million Rands a total of shares, of debentures, and the debentures were at 4 Rand each. So if we divide the 2 million by 4 Rand, we're going to get 500,000, right? So that is the total number of convertible debentures. In that specific question, they didn't give us any ratio, so we can assume that each debenture will be converted into one ordinary share because there wasn't a ratio. But in your questions, you must always look out for a ratio, a conversion ratio. Okay. Now, in the prior year, that 500,000 debentures were issued on the 1st of April, so we need to wait it for 9 months of the year, and we're going to get an amount of 375,000. We add that to the basic WANOS that was already calculated. We get 3,002,875,000. So now let's have a look at what that looks like in our actual calculation. We are going to copy those amounts as they were, and we say dilutive earnings divided by diluted WANOs. Again, diluted earnings in the prior year divided by diluted WANOs in the prior year, and we calculate our amounts. So if we have a look at the effect, there was a dilutive effect. It went from 32 to 31. And also the prior year, there was a dilutive effect. It went from 30 to 29. So in both of those cases, we had a dilutive effect, and therefore we had diluted earnings per share. Okay, so that's basically the end of this question. When we look at the disclosure, again, very simply, it's a reproduction of what we have already calculated. So there's nothing very much new that we need to work on. All right. So here again, they're just saying we started off with profit, we added the saved interest on the debentures after tax, and we came up with an amount. Now, interesting question: why didn't they start off with profit for the year and then minus cumulative preference dividends? Remember what our calculation looked like. So in this calculation, we started off with a profit for the year, right? We started off with our profit for the year. We minus the cumulative preference dividends. This always stays the same, regardless of what question you're doing. We came up with our basic earnings, and then we took out any dilutive instruments, and then we came up with diluted earnings. The reason why they didn't start with profit for the year is because it was meaningless. It wouldn't have helped at all. So in terms of the presentation, it was just going to complicate the presentation and make it difficult for the users to understand. So therefore, in this specific question only, they started off with the basic earnings per share. So as a rule of thumb, if there isn't any cumulative or non-cumulative preference dividends, you should actually start with basic earnings and just show a reconciliation between those two amounts. The users of financial statements will be able to identify that this 800,000 here is actually the same amount that we find on the income statement. So we started off again. When we look at the WANOS calculation, we have the WANOS, which is equal to the shares at issue at the beginning of 20X9. We add the dilutive effect of the convertible debentures in both years, and we come up with the final amount. So again, it's very similar to the calculation that we did, and in fact, it's a reproduction. So that is exactly what and how we disclose our earnings per share. The disclosure is important, but if you get the calculations right, your disclosure is going to be very easy. Okay, guys, thanks for watching this video. Please go home and try to redo this question. It's 14.12 in your textbook, so it's on page 207. Please try and redo this specific question in your own time and at home. And all the best, and I'll see you in the next one. Bye-bye.